Hello everyone, so my topic is all about capital gains tax on sales, exchange, and other disposition of domestic stock directly to buyers. Ano nga ba ang capital gains tax? So, ang capital gain arises from the sale, exchange, and other disposition including back to the retro and other conditional sales of capital assets. Capital gains, its general rule is applicable taxation scheme is regular income tax. So, ang exception rule niya lang naman is applicable taxation scheme is capital gains tax. Capital gains subject to capital gains tax. There are only two types of capital gains subject to capital gains tax. The first one is capital gains on the sale of domestic stocks directly to buyers. Then the second one is capital gains on the sale of real properties not used in business. Ano nga ba ang scope of capital gains taxation? Gains of dealings in capital assets. So, ito yung topic natin. Ito yung i-discuss natin. Gain on sale, exchange, and other disposition of domestic stock directly to buyers. So, ang tax rate niya is 15% CGT. The second one is sale, exchange, and other disposition of real property in the Philippines gains from other capital assets. And yung tax rate niya naman is 6% CGT. Then, gains from other capital assets. Ang tax rate niya naman is regular income tax. So, dito magpo-focus tayo sa first, which is the gain on sale, exchange, and other disposition of domestic stock directly to buyer. Kung saan may tax rate na 15% CGT. Din tayong modes of disposing domestic stocks. Shares of stocks may be sold, exchanged, or disposed through the Philippine Stocks Exchange or PSE. So, ito yung mga corporation na malalaki, yung mga kumikita ng 50 million and above. Gaya ng mga Jollibee, GMA, Meralco, yan, yung mga kumikita ng malalaki. That is why na talagang giant corporation, they offer their shares to the public. The second one is the directly to buyer. Yan. So, yun, pwedeng ibenta yung shares of stocks natin through the Philippine Stocks Exchange or PSE, or pwede naman directly to buyer na. Now, let us move on to the nature of the CGT. First one is the universal tax, meaning it applies to all taxpayers disposing stocks classified as capital assets regardless of classification of the taxpayer, whether it is corporation or individual. It is applicable. By situs, the gain on sale of domestic stock is within. So, the tax applies even if the sale is executed outside the Philippines. So, basta domestic stock yan at directly to buyer, applicable siya sa lahat ng uri ng taxpayer. At nag-a-apply pa rin siya even the sale is executed outside the Philippines. The second nature of the CGT is the annual tax. It is imposed on the annual net gain on the sale of domestic stocks directly to buyers. So, dito kailangan alam natin kung paano mag-compute ng net gain. So, ang formula ng net gain ay net gain is equal to selling price minus basis of stocks disposed minus selling expenses minus documentary stamp tax on the sale paid by the seller. Dito, para makuha natin yung net gain, kailangan kino-consider natin tong formula na to. Yan. Then, the documentary stamp is deducted if paid by the seller. Selling price shall mean, in case of cash sale, the total consideration received per deed of sale. So, dito, napaka-explanatory na naman, self-explanatory na naman niya. Basically, kung magkano yung natanggap mong cash, then that is the selling price. Then, if total consideration is paid partly in money and partly in property. So, paano kung may natanggap ka na consideration na pera at may kapalit na property? So, paano mako-compute yung selling price? So, the sum of money and fair value of property received. So, yun. That is how we compute the selling price. In case of exchanges naman, the fair value of the property received. I'll show you an illustration on how to compute selling price. So, Mr. Cole sold his stocks, receiving in exchange a building with a tax basis of 2 million, but with a fair value of 2,500,000, goods worth 100,000 pesos and 400,000 cash. So, the selling price shall be computed as follows. Ang fair value of building received niya ay 2,500,000. Then, its fair value of good received naman ay 100,000. Then, the cash is 400,000. Simply add this 3. Then, kung ano yung magiging sagot, yun yung magiging selling price. So, 2,500,000 plus 100,000 plus 400,000 is equal to 3 million. So, ito yung magiging selling price natin.
I'm going to report what is the tax basis of stocks. The tax basis of stocks you purchase is what you pay for it, plus the commission you pay. For example, you buy 100 shares of XYZ Inc. at $40 a share, and you pay a $100 commission. So the total cost is $4,100, and the tax basis of each of your shares is $41. So there are the 5 tax bases of stocks. The first one, if acquired by purchase, tax basis is the cost of the property, which will be determined by the following methods in descending order of priority. There are the 3 types of methods in descending order of priority. The first one is specific identification. If the shares can be specifically identified. The second one, moving average method. If books of accounts are maintained by the seller where transaction of every particular stock is recorded. And the last, first in, first out method. If the stock cannot be specifically identified. So, the cost basis is the original value of the asset. For tax purposes, usually the purchase price adjusted for stock splits, dividends, and return of capital distribution. So, the second one of tax basis of stocks is if acquired by device, bequest, or inheritance, the tax basis is the fair value of the time of death of the decedent. So, the basis of property inherited from decedent is generally one of the following. The fair market value, FMB, or the fair market value of the property on the date of the decedent death. The third one, if acquired by gift. The tax basis is the lower of the fair market value at the time of gift, and the basis in the hands of the donor or the last preceding owner by whom it was not acquired by gift. So meaning, if the property was acquired by gift, the basis shall be the same as if it would be in the hand of the donor or the last preceding owner by whom it was not acquired by gift, except that if such basis is greater than the fair market value of the property at the time of the gift, then for the purpose of determining loss, the basis shall be such fair market value. And the fourth one, if acquired for inadequate consideration, the tax basis is the amount paid by the transferee for the property. Meaning, if the property was acquired for less than inadequate consideration in money or money's worth, the basis of such property is the amount paid by the transferee for the property. And the last, if acquired under tax pre-exchanges. The tax basis is the substitute basis of the stocks, meaning the substitute basis of the properties transferred shall be the original basis of the property, stock or securities to be transferred less money received if any and the per market value of the other property received. Here is the illustration 1. Cost of acquisition. Mrs. La Carlota purchased 1,000 shares of Bacolod Corporation for 100,000 and paid the broker's commission of 1,000 pesos. The stock were subject to a chattel mortgage of 10,000 pesos, which Mrs. La Carlota assumed. So, the cost of basis of the acquired Bacolod stock shall be cash paid amounting to 100,000 pesos plus obligation assumed on the property purchase amounting to 10,000 pesos plus direct acquisition cost and broker's commission amounting to 1,000 pesos. So, the total cost or tax basis is 111,000 pesos. So, that's all. Thank you.
What is the basis of stocks? A stock basis is used to determine the amount of profit on the sale of the stock is subject to capital gain taxes. The basis is usually the amount of the stock plus any commission as the date it was acquired. Definition of tax basis of stocks. Investors pay capital gain taxes when they sell investments such as stocks, bonds, and real estate at a profit. The amount of profit and by extension, the amount of taxes due is calculated using the investment basis. How do I calculate the basis of stocks? You can calculate your cost basis per share in two ways. Take the original investment amount and divide it by the new number of shares you hold to arrive at the new per share cost basis.